All right. Good morning, everybody. Welcome to the House Committee on Government Operations and Military Affairs. It's Wednesday, April 19th, and we are starting this morning with testimony on S42, which is the divestment bill. And I want to welcome our treasurer, Michael Patak, here. So thanks for joining us this morning.
Yeah, well, thank you, Mr. Chair. Pleasure to be here with you and with the committee as well. I believe you had a walkthrough already of the bill and also a walkthrough from the Senate. So I think I was just going to plan to talk a little bit about my perspective in terms of where we landed on the Senate side. And on the Senate side, I agreed and supported the bill, and I still agree and support the concept. At the end, there were some additions that the VPIC, the Vermont Pension Investment Committee, would have liked to have included that were not included. Just as you know, legislative process can work quickly sometimes, and they are things that I believe the Senate would be in agreement with. I can't confirm that, and I think there are things that other stakeholders would be favorable or favorably inclined toward as well, but you should talk to them to confirm that. So, the bill originally started out, and we proposed an amendment that largely would have exempted indexed funds and private investments, so private equity and private credit. That was something that was a compromise we were working on for, quite a bit of time over in the Senate side, if I can remember. That ended up being amended to the current version of the bill that has a few additional exemptions and a few different language changes. But we really approach this issue from a standpoint of, do no harm to the pension system and to the investment returns and to the costs of the system. You really want to make sure that the pensions are strong and healthy. We've done a lot of work to shore them up in the last few years, as I think everyone on the committee is aware of. The future in terms of investment returns and what the prospects for pension systems look like over the next decade. It's not totally sunny and clear. There's some concern on the horizon. So obviously, from the treasurer standpoint, we wanted to come to this issue with a do no harm perspective. So the bill, I think provided a flexible framework around this issue of divestment. There are a few pieces I'll mention that could provide more flexibility or more security for VPIC. But it also includes a study that I think is really important. The study would look at the fossil fuel holdings within the Vermont pension system. Currently, we certainly have estimates as to how much fossil fuel related positions are within the pension funds, but there's no certainty around that. And I think that would be a very useful thing to know and to measure, because obviously, if you're not measuring something, you're not really understanding if it's getting bigger, getting smaller, improving, not improving. So there is a study in here that would relate to measuring those fossil fuel investments, which I think is a critical piece of the bill and something that is really important. So the other piece of it, I mentioned the exemptions. The Senate included, like 3 or 4 different sort of fiduciary duty related exemptions. So the plan would apply to direct holdings, to indexed funds. They would require divestment under this plan to be created by VPIC by certain dates. But then there are also exemptions to moving forward with the plan, fiduciary duty exemption that's sort of broad. There's a de minimis exemption. So even if you're executing on the plan, you can hold a small amount of securities in the fossil fuel industry. The Senate added an exemption that if it was going to impact the ADEC, that the plan would stop moving forward. So if there was increased costs to the system that the state of Vermont would have to pay or employees might have to pay, that would be a reason to not move forward with the plan. And then there was an exemption around private equity or private credit, private investments, basically. And the two pieces of language that, were a little bit different than an agreement that we had reached on the Senate side related to that de minimis exemption and to the private investment piece as well. So we'd be happy to provide language that I think would be acceptable to everybody, but just generally what parties seem to agree to on the de minimis, the sort of 2% that you can maintain in your pension funds, was that would be ongoing, that there wouldn't have to be a fiduciary duty-like decision to determine whether you could maintain 2% in the fund or not. There was sort of an ongoing ability to have some de minimis amount I think that was in recognition of a desire to continue to do engagement on VPIC's part. It was an acknowledgement that it's hard for a VPIC-like pension or VPIC-like investments, I should say, to unwind every single piece of fossil fuel holdings potentially, because many of them are in index funds and private credit that we don't have the ability to just go out and sell. There are other people that are sort of putting those together and controlling them. We're participating in them. And then also just a recognition that would provide more flexibility under the plan. So there's that piece. And then there's the private investment where, if I remember correctly, private investment wanted to be included in the study and the ability to measure how much fossil fuel is in the system, but it would not necessarily be subject to the plan until there was a study conducted. And I think that was sort of what, I think that's sort of, there was some language, and again, we'll provide this to you, to provide just a little bit more clarity on that point. Right now, I believe there's a fiduciary duty decision that needs to be made to not move forward with this plan as it relates to private investments, and VPIC had asked for some more affirmative language. And I believe the language would be more consistent with what we had discussed and agreed to on the Senate side, just again, didn't make it in. And then there's another piece that has come up subsequent to the language in the Senate side, which really relates to immunity, no private right of action, sort of legal protections for VPIC and VPIC members, or the commissioners of VPIC. I think I view it as something that would be wise to do, just as a belt and suspenders approach, that it would provide assurances and support for individual members of the VPIC committee that they're not holding themselves out to liability, even if it's not legitimate liability. There's always opportunities for people to make allegations and to sue. And providing immunity, no private right of action, that kind of legal protection and immunity, while still making sure that they're executing on their fiduciary duty obligations, I think would provide some well-deserved and smart protection for individuals that serve on VPIC. At least give them peace of mind and assurances that they're not going to run afoul of someone that disagrees with the decision here. So those were the main provisions that I would certainly recommend that the committee consider in more depth on this topic and think about including in the language of the bill on this side of the House, or this side of the State House, I should say. But I think those are really the points that I wanted to mention. I also wanted to mention actually that, just on the Senate side, and, again, I was mentioning how things had moved quickly, and I don't know if every stakeholder had an opportunity to express their viewpoint. So just a suggestion, there's 3 different systems that are impacted here: the teachers, the state employees, and the municipal. So the teachers and the state employees do get, direct state support in different amounts. The municipal system really is from municipal dollars, but VEMRs did not get an opportunity to at least testify in person, I believe, on the Senate side. And we were just at a VEMRs meeting for their system yesterday, and I mentioned that to them that I would make that point here just to make sure they're able to have their voices heard on this. Hey, good morning, Representative.
On the divestment thing, I've always sort of made the comparison of you're either sitting in the stands eating peanuts or you're out on the field playing. We have not shaken the earth with our engagement of corporations and trying to move them to another place, but at least we're voices there that other funds and individuals have rallied around or rallied with. And there has been some modification of positions. So that's been a positive thing. I'm just going to hit points as they flash through my head of what you said. So engagement, I think we should stay on the field, which means I don't think we should just automatically exit certain strategies because they're not popular. I think there's just no possible way of not seeing a serious increase in our funding necessary to maintain the plan as it stands. And I suspect that will roll out to the ADEC fairly significantly. So the question comes up of where's the money going to come from? I assume you're sitting here with your treasurer's hat on. So where's the money going to come from? And lastly, Beamers would be impacted, I suppose, because we don't run a separate investment portfolio just for them. Everybody's in the same deal. And both the indexing and the private equity, private credit, and stocks and bonds, all the other things are combined, basically. So they would take a hit also, I would assume. I think that's it.
All right, well, thank you very much. On the engagement piece, again, I think you want to hear from VPIC, but the language that would change that I mentioned, the 2% de minimis to applying basically as a permanent de minimis amount. I think that would address some of the concerns around engagement, because you would be able to continue to hold a small amount for a whole host of reasons. But one of the reasons would end up being that you then have holdings that you could do engagement with. So again, I'd hear more from VPIC on that, but that part I think would satisfy at least my concern on that front. On the where's the money going to come from piece, like I mentioned, I come to this from a do no harm, which is another way of saying from the treasurer's hat, I guess. And, there are the exemptions that are in the bill. I don't see them as creating a situation where it would be a significant loss to the system. I think it's a slow and thoughtful approach. Even that one exemption I mentioned that was added on the Senate side that would expressly say don't continue with the plan if it's going to raise costs or the amount of the ADEC, whether that's on the expense side or on the investment loss side. So that I view as another belt and suspenders to, general fiduciary duty exemption that exists, and then the exemption from private equity.
Well, we're kind of teetering on the go below 7% now, which if that happens, the only.
Yeah, I mean, the assumed rate of return, separate from this conversation, is, one of the main, points that you want to watch. One of the main areas of concern, I would say, had nothing to do with, Vermont or Vermont's pension, just what you expect to see from the markets over the next 10 years. I know at the most recent VPIC meeting, there was some optimistic information in that regard as to expectations to hit 7% over the next decade. So that was an improvement, that the likelihood of hitting that number has gone up in the recent few months or maybe last year. But that's still something that generally, you want to keep a close eye on. And, the framework that exists here with these additional inclusions, I would be hard pressed to see that these specific reasons would drive the investment rate of return, anywhere different than what is going to happen naturally by the state of the markets. Oh, you also mentioned Beamers, and I think that's right. I mean, the funds are all pooled together. So we talked about that a little bit at our office yesterday, that I think like, for example, in New York City, they have different pension systems, and they move forward with that divestment plan. But the divestment plan only included their municipal city employees, their teachers for the city, but did not include the firefighters or the police pensions. So they didn't have a divestment approach to all of their pension systems. But, in New York, those are separate entities. And here it would be costly and complex to, try to pull out the different funds. And you would lose probably some opportunity to invest in certain funds because you don't have the same size and scope. So that would be a challenge to try to do that, I think.
Mr. Treasurer, one of the things that you mentioned was that in one of the versions that didn't make it into the Senate as passed, that the exemption that applies to private equity investments was also applied to index funds. And one of the things I've been having trouble wrapping my head around is how we would the whole idea with an index fund, and maybe you can explain that to the uninitiated who didn't go through what we went through the last couple of years in GovOps in its previous incarnation. But how would we, I'm trying to think of how would we have a divestment strategy that would really work? I mean, are there index funds that just don't, that are specifically sort of fossil fuel free already that other people have as a standard? I mean, how would we divest from index funds without sort of getting ourselves into some trouble? That's what I'm trying to figure out.
So there's two, I mean, there were two, I think everyone sort of agreed that the direct holdings were relatively limited, and that was a much more straightforward, type of situation where you could go and sell them, and it didn't cause a lot of, cost. It didn't, you could replace them with something else and maybe didn't lose too much from a diversity standpoint. But the index funds and the private investments were two of significant focus. The index funds, I think it comes down more to the expense, like how much is it going to cost? I think on the private investment side, it's more about, are you going to lose the ability to gain returns? So on the index fund, the reason I say it's more about expense is because there are index funds that are green, that are fossil free, that are, you can go the other way too and get, I think they're like a sin index fund out there too. But, there are funds that structure their funds that way, but they tend to be more actively managed. So it requires more, expertise and more active review of which funds are in the index fund to ensure, that for some reason a company that was not considered fossil fuel now is, or whatever it might be, or merged with another company. So it's more actively managed. And as a result, the expense ratio is higher than maybe like a standard S&P 500 index fund where you're just saying, somebody else is determining what's in the S&P 500 and we're matching our index fund relative to that series of businesses. So that has changed. That ratio, it still does exist. I mean, there is a difference in cost, but it has been getting smaller over time as, managers can do this more efficiently and more effectively. The SEC this month is supposed to be releasing rules around public companies releasing their basically carbon footprint, their climate impact. And I hope the SEC does that. I think it's a smart, transparent policy move for investors. But if they do that, it would be a lot easier for index funds and managers to be able to put together lower expense portfolios, because they would have a standard that every publicly traded company had to disclose to, and you could easily determine, who's above or who's below when you're setting up your fund. So there's an expense piece of it there, much more so than losing of the return on investment. But the expense difference has gotten smaller over time, and I think there is a prospect that it would continue to become more even with the traditional index fund. I don't know what that time period would be, but if the SEC makes that kind of rule change, it would certainly put wind in the sails. And then you go back to the de minimis amount. So depending on what that number is, you could still have an index fund that had a limited number of holdings that could fall under that exemption. So you wouldn't have to get out of that position simply for the fact it had a limited number of holdings. So that's another consideration there.
So I'm really stealing a question from Representative Hooper of Burlington that I didn't even ask. And he asked it before, and that's, is there an actual definition for fossil fuel company?
There is not in the bill. The bill, which is I didn't get into this, but I think one of the other things I thought the Senate bill did well is that it provided a lot of flexibility and responsibility to VPIC to come up with some of the definitions and the critical definitions like fossil fuel company, and then to come up with the plan around the concept of divestment. So there isn't a definition in the bill, and the thought was to have VPIC be thoughtful and study it and propose a definition.
And then if I could just follow up too, I know, following the conversation, you're talking about, is it the FCCs that's looking for the carbon footprint of companies?
The SEC? Yeah.
Any concern there about us eventually even going further with that and looking at companies that, have a high carbon footprint,
Right.
output and saying, we don't want to touch them? I mean, I just have a concern that, it could open the doors for a lot more.
Yeah, so I think your concern is basically there'd be a company that would have maybe it's like Amazon that is not a fossil fuel company, but they have a tremendous transportation network and maybe they're contributing to, much more CO2 than anticipated. So, that would be for the legislature to, deal with in the future. But I think from an SEC standpoint, it's important for investors to know that kind of information, particularly if it's a company that on its face you might not think of as having a significant environmental or carbon impact. So I guess my answer is I think it's important that investors generally know that information. Whether it goes further, it would have to be something the legislature, I think, would have to act on, or VPIC would have to decide, or any fund manager would have to decide the risk here in terms of, the financial risk. I mean, in terms of how this company operates is too significant for us to continue to have holdings in it, because we think this transition that is occurring and will continue to occur to a more sustainable green energy structure, that this company cannot survive that transition or won't be able to survive it in the same form. So unless there's a legislative direction or unless there's sort of a risk management determination, I think either of those things would have to happen for a pension fund to act on that information.
And I could follow up, but, again, just following this train of thought, is there a specific, or are there specific guidelines for companies to determine their carbon footprint, or can each company have their own consultants and figure it out?
No, it's a great question. And that's why the SEC is doing what they're doing, is because, they haven't put out their final rules, so we don't really know what's in it yet. But the conversation related to, there's sort of like 3 tiers, if I remember correctly. This is really testing my memory from a year or 2 ago when we wrote a comment letter, but it was basically which level of carbon impact are they going to measure towards? So is it sort of these initial impacts? Is it sort of these indirect impacts? And that was a big conversation. So like, for example, if you're FedEx or you're a company that doesn't have your own planes or transportation network, do you include the cost of transportation, the carbon impact, or where do you cut the line? So the SEC hasn't landed on that yet, but that's an active debate. But one of the things that they did include in a proposal, which I thought was really useful, was a requirement that the CFO and the CEO sign this disclosure as part of their annual statement, which really elevates the degree to which they have to apply due diligence and analysis to these kind of disclosures. Because, if that's false, I mean, that's an SEC violation, that's a potential criminal violation. So it really elevates the bar. And they're trying to get at this greenwashing that can occur where a company says, look how wonderful we're being on their website. But it's really marketing materials that's designed by their marketing department and not the kind of disclosure that would go through the rigorous due diligence of experts and lawyers and financial advisors to go into an annual statement. So it's actually what they're trying to do is create a uniform system that would cut against what some people are seeing now as greenwashing by certain businesses.
Again, a concern. I mean, just thinking this through, there's companies out there that are purchasing carbon sequestration credits to green up their portfolio in a sense. And I mean, I would think that would play into it as well. But I don't know.
Well, you would certainly see that, right? Because you would, I hope you would see that in the rule. Again, we had to wait for the final rule. But, so for example, if a company said we're net zero because they were doing that, and that's all they were saying on their website, now, based on the standard, you'd have to see what their carbon output was, and then you would see separately, what they're doing in terms of carbon, in terms of buying credits or whatnot. So I think the reason I like it is because it provides more transparency around this issue for investors relative to public companies. And it's something that other parts of the country are doing as well, other parts of the world. Yeah.
Sure, I guess I want to got to a level that I don't think we quite hit today as we're framing up our continued conversation about this bill, which is, you came in initially saying you're supportive of moving in this direction. There's some language that you'd like to see that hasn't made it into the bill, which I think we should be working on. And I'm very interested to hear what other folks from VPIC have to say on some of those items that you brought up. But I just want to ask you generally, does your support stem from the fact that there is inherent risk, both from the regulatory things that are going to be happening over the next few years, nationally and internationally, around climate policy and decarbonization and the way our energy systems are changing, that presents a risk to the systems that isn't always really baked into experience studies, actuarial rates of return, the way that we currently measure the forecasting for our things like our pension funds? I mean, is that really what we're trying to get at here, is that there's a kind of a missing component of risk?
Yeah, I think you can approach this issue from that risk perspective, which is sort of where I've always sat on, coming from DFR. We did a study looking at our insurance marketplace and saying, what's happening with our weather, what's happening with the climate in Vermont, and how is that going to change underwriting practices for our insurance companies going forward? So if they have more severe weather in the spring, more hail, more wind, and they're having a lot more claims in that regard, they should be adjusting for that risk factor. Same thing with their own investments. If they're in a life insurance company with 30 years out of potential liability, and they have significant investments, that have the potential to be stranded over time because of how, how the energy market's moving, how the sort of transition to green energy is going, then they should be mindful of that and managing their portfolios to that. So I think so that's the viewpoint that, coming from a regulator, we address this issue with, which is the risk factor. And that's why I think the study is so important, because we don't have a real strong measurement of that risk right now. We don't know what the number is. We don't know if it's 5%, 2%, 1%. And that's a good baseline to start from, to know what your exposure is, and then understanding how much risk there really is to manage. That's again why I think it's a thoughtful approach is necessary. A thoughtful, slow approach is necessary, because this transition's happening. It's happening over the next decade or two. We have to be mindful of it and respond to it. You could also approach this issue from, more of an advocacy standpoint and a value statement against certain companies. But, that becomes really challenging as to where you draw the line on companies. But when there are companies that significantly, have a real possibility of not earning the same kind of profit that they've earned over the last 2 decades or 3 decades, that's something that you should have on your radar and be mindful of.
Representative.
And I think I agree with that. The study should be our first step, and maybe then everything will fall into place after that. It seems to me like we're dealing with a political discussion that could have financial ramifications. If we divest from any fossil fuel company, somebody else is going to come in and buy the shares or whatever. The impact on the company itself will probably be negligible. Once again, it would be a symbol that we're proactive in engagement in some way, but we'll be in the stands. And the financial end of this is eventually it's going to fall down to the plan and its members to somehow make up the deficit. And that's effectively saying taxpayers, which that's another whole discussion, I guess. Which is odd to say, because I actually support the idea of cleaning up the atmosphere.
Representative Waters Evans, go ahead.
You and I just made the same face, but here's my question. How do we know that there's going to be a deficit?
Well, I think it's unlikely, just because of the different exemptions that are included, and even just the concept of itself. I mean, I think from a risk standpoint, the type of returns a company is getting today in the fossil fuel sector is going to be different than a decade from now in a considerable way. So that is how. So you have to create a plan to manage that risk. And VPIC has done. This committee hasn't had the opportunity that we talked about on the Senate side of the work that VPIC has done in this regard. Having a decarbonization policy having ESG policy and, being actively engaged with these companies. So it's not to suggest that this is not happening now. I'm just generally talking about, how I think you have to approach it with this sort of prospect on risk. And then separate from that, there are these exemptions, obviously there's the core one is the fiduciary duty exemption. So if you think you're not going to get the same kind of monumental returns for some reason by following through on this plan, and that's a reason to pause the plan, this de minimis exemption in terms of being able to hold on to a small amount, making sure that the private credit is sort of private equity and credit is sort of off to the side where the biggest opportunity for returns are. And then also this ADEC exemption too, like if it's going to drive up costs to stop the plan, pause the plan as well. So, I think structurally it's the right kind of risk to be managing. And then exemption wise, I think there are quite a number of opportunities to pause if it looks like there would be this kind of deficit.
Yeah, I guess the reason maybe my face turned up a little bit in trying to think about the way that Representative Hooper described the risk, because my read of S42 is that it is designed to say we're moving in the direction of divestment. We have these exemptions that we know would have an impact, and there's sort of there's going to be a big impact on the ADEC. The do no harm maybe needs to be strengthened here, but the idea is that it's baked into the bill, right? The idea that we don't have to move forward with that plan if it's going to cost the taxpayer in terms of an increased ADEC. And I also just want to say that the idea behind this bill, if you support any divestment, is that you fundamentally understand that we haven't done a good job over the decades of baking in the real social and environmental costs of our economy. We've just done a terrible job at it. I just, we knew about greenhouse gas emissions when I was a little kid, and here I am, approaching 40 and at this committee, and we're, talking about like the idea that we would continue to invest in people who are extracting things that are warming the planet is just out. That's the place I sort of stay rooted in. And so the risk to the funds is also in staying invested in things that we know are going to get increasingly regulated as the world warms and governments decide to. So I have trouble with the characterization of this concept generally being that it's going to be a negative financially for, especially when we're looking at these 5, 10 plus year horizons, doing a study, understanding the impacts, and trying to take this thoughtful approach. So I don't want to leave anybody with the impression that we're trying to put the pension funds or retired teachers or retired state employees on the hook.
I think that's a very good perspective to have. I mean, it's about managing that transition. If you do it too quickly, you could, and there's also some specifics with Vermont too, right? Like there are these vehicles that we're investing in that we don't have control over how they are designed or how they look necessarily. So we have to take that into account in terms of being thoughtful with the transition. And then to your point, like it's governments responding to global warming crisis. It's individuals changing their own behavior. It's organizations changing their own behavior. Certain states saying they're not going to sell combustible engines after a certain point. Auto manufacturers saying they're not going to make them after a certain point. Like it just, over the next 10 years, give or take 5 years, there's significant changes that are on the agenda in terms of, how we currently operate in our economy. And we just have to be mindful of those.
Any other questions for Treasurer Pichak? Mike, thank you very much.
Yeah, for sure. We'll be happy to provide the language we mentioned. And if there are any follow-up questions, please let us know.
Great. Thank you very much. I'd like to invite Chair Kalanka up. Thanks for joining us this morning. I'm sure you'll have a lot to respond to from the treasurer's testimony and some of the questions we had for him. So I'll just give you the floor and then we can ask you some questions too.
Thank you for having me. I know some of you around the table, but my name is Tom Kalanka. I'm chair of VPIC. I've been a member of VPIC since 2014. I was appointed by Governor Douglas at that point for the Beamer slot, reappointed by Governor Shumlin. I became chair in 2016 when I left my role as city councilor here in the city of Montpelier. I'm very committed to pensions. This isn't about whether or not we want to own fossil fuel stocks. This is really about VPIC's autonomy, issues in regards to costs, issues in regards to what impacts you do today could have on future beneficiaries of the trust here in Vermont. It's currently about a little less than $6 billion. Our VPIC members take this responsibility seriously. Fiduciary responsibility is our primary concern. And we do actively work with climate action. Katie Green, I would strongly recommend you bring her in here for testimony. She testified at the Senate. She's a tireless advocate for environmental issues, and it's built into our DNA at VPIC in regards to how we view investment managers, how we hire investment managers, how we fire investment managers. We currently have about 45 investment managers that manage the pool of funds. To understand the complexity that you're looking at, that entails about 75,000 positions. So if you compare that to your individual portfolio, we have about 75,000 positions. That's broken into the 3 different trusts, so about 25,000 positions per trust. That's further broken down into about 10,500 individual issues. So I just want this committee to understand the magnitude of what the legislature is asking VPIC to do. We need to come up with a plan to divest. And that's another issue. Divest is a tool. We view it as a tool. We view it more as a tool of last resort, not necessarily as first resort. And because of that, we feel that our advocacy work, as well as Katie's work, working with climate action groups with BlackRock, our progress that we've made since 2017 with our divestment committee that was co-chaired by myself and former Treasurer Pierce. We've met all the goals of that divestment task force back in 2017, including seeding a $200 million low carbon index fund with BlackRock, which we're looking to get other vendors. We have money invested in lower carbon index funds, and we're working towards that initiative. The key issue with us with Senate 42 are really 5 things, and I've included that in my testimony. You can see our memo with recommended actions, recommended changes that we would be comfortable with. We were supportive of the Treasurer's suggestion that index funds be excluded, mainly because over the past 5 years, we've had 2 pillars of our investment philosophy. One has been lowering costs through indexing, and the second has been working with private equity to build up work with top tier managers in the private equity space to be able to meet our rate of return assumption, which is currently at 7%. We're at the table there with a couple issues. We do get into top tier managers. Top tier managers will not change their contracts for a state like Vermont. They just won't. We do not have 200 employees like California or New York. So we cannot do certain things that other states do. We rely on top tier managers to really perform for us and to provide us the extra rate of return that will get us to the 7%. Katie Green, and I strongly, once again, ask you to bring her in here. She's part of the Climate 100 group with BlackRock. That's a representation of about $66 trillion in assets here in the United States. And that's working towards not divestment, but net zero, and working towards net zero initiatives, forcing companies to actually create net zero pledges and actually investing in a net zero initiative versus divestment. Once we divest, we lose that ability to you work, Katie. We lose that ability to be part of that network. It's been said that the de minimis exclusion will allow us to continue. Well, that's to be debated. The current language, as I read it, or as I came out of the Senate, didn't extend de minimis past 2030 and didn't extend it to 2040. One of our key recommendations is to make sure that's clear, that the de minimis standard in the bill extends indefinitely, because we really don't have the ability to pick and choose individual stocks. And it's not a matter of can we sell the stock, we potentially could. The question is, how do we mandate our managers, or how do we buy index funds that aren't overly prohibitively expensive? And so with that, I don't really want to read my presentation because I think you can read it. You can ask me any questions on it. There's really 5 things that I think I want to leave you with that I think VPIC has concerns with, and how we get to any type of revisions or amendments. We're open to that change. We do support the idea of exempting index funds and exempting private equity as this first year step until we complete the study. That's how Middlebury does it. They've exempted completely index funds as well as private equity as a first step, and they have different stages that they look at. I think that would give VPIC a lot more confidence that we'd be able to meet your goals and objectives. The first thing I really want to say is, well, what is the role that we should play here in Vermont in terms of climate action? And we feel divestment will actually lower Vermont's impact on climate action from what we're doing today. If we divest, we will no longer be able to have Katie Green represent us with that $66 billion or $66 trillion worth of assets. She's done tremendous work, and I'd hate to see us lose that initiative. The second piece, and you'll see this in my testimony, is we have a fiduciary attorney that we hire. And this bill, he has indicated to us, and there's a letter from him dated last week, that this bill will open VPIC and the state up to liability on both ends. You know, people who want to divest, people who don't want to divest. This bill, he feels, is tailor-made for a lawsuit. And he gave an example, a lawsuit that happened in California, where commissioners in California were brought through the ringer for 5 years, and it ended up in bankruptcies, lawsuits, and it's a significant disincentive to get volunteers to come work for VPIC. We already have a difficult time getting staff because of our compensation study, which we submitted earlier this year, that shows that we pay our staff 10 percentile of their peer group in terms of managing money. We're working on that issue too. But to also get volunteer staff to man these boards is a tremendous concern. This, I think, would be the tipping point where we would lose good members on VPIC if you do not have language in this bill that would protect from us from a fiduciary point of view. Basically says, if we decide it's not in our fiduciary interest, we don't have to follow through, or we do follow through, whatever, whatever language you see fit. He suggested some language that I supplied here. I think that would be an essential that VPIC would need to see. The third issue I do want to bring up is costs. Inevitably, this is going to cost more. Since 2016, we've gone on a strategy to lower costs through indexing. We're paying 2 basis points. Now, 100 basis points is 1%. So for every 1 basis point increase in costs internally, it costs us about $560,000. So let that sink in. Since 2016, we've lowered our overall cost of the pension trust from roughly 65 basis points down to about 43 basis points. Now, it doesn't seem a lot, but when you talk about lowering the cost of running this fund, back in 2016, it cost about $25 million to basically all in, run this trust. We're paying less than that now, all in, than we were back in 2016, and we have twice as many assets. You really have to look at it that way. And we also have incorporated a professional staff with a CIO that we brought in to help us manage these investment pools at a top-notch level. And you'll see, last year, for example, it was a terrible year. We were down like 7-8%. We were in the top 50 of 1,000 pension funds in Pension Investment Magazine. In the year before, we were up about 26%, which was in the top tier. So we've been managing these ups and downs through our indexing strategy and our private equity, as well as advocating for climate action in our portfolio. Costs are going to go up, both internally as well as potentially externally. And what I mean by that and externally is could be potential unintended consequences if we're forced to lower our assumed rate of return. Why would we do that? Well, the biggest issue is private equity. Private equity provides most of our return above that 7% rate of return. If we have to exclude those asset classes from the mix, just simple math would mean we will not be able to meet the 7% rate. And then we'd have to address that issue. In Act 75 2 years ago, we were given authority to set the assumed rate of return. We don't plan on reviewing it until next year, but this would be a serious consideration that we have to take. The bill as written, according to our CIO, Eric Henry, he's indicated that we will have to start winding down some of our commitments as soon as 2025. If we start winding down or unwinding our commitments to private equity as early as next year, even though it's a 7-year, 10-year, 15-year time horizon, we just won't be able to meet those rate of return assumptions. And so we'll have to seriously consider whether or not we can maintain the 7% rate of return. If we lower it to 6.5%, that's about $50 million in extra cost. It's about $750 million in extra cost between now and 2038, which is the end of the amortization period. I'm not trying to scare anyone with that. Those are just reality. That's the reality of where we're at. If we are excluded from certain asset classes or we have increased costs internally, it's going to ultimately lower our rate of return on the plan. It exposes us to more volatility. I know there was a question earlier in regards to what's next. And I think that's the clear point. If we have to exclude energy stocks, what's next? Trucking, transportation? Is it plastics? Is it, what comes next? And how much further do you have to increase in terms of the expected variability in the portfolio in terms of risk? And we measure both return and risk. So both sides of those equations could be potentially impacted. Our estimates are in a divested model would be increased variability by about 0.5%. It doesn't sound like a lot, but over 20 years, it could be quite significant. And so as a fiduciary, we're charged with maximizing return and minimizing risk. So I think we have to look at both ends of the equation. And I think in both ends, this bill is subjecting us to concern. And that's why we really advocate for the not necessarily a pause, but actually looking at this study first and then potentially including mandates. The last piece or another piece, how will VPIC reconcile, the legislative intent that's written if the language of the study next year comes back that it's going to cost more and it's going to increase risk? How are you going to respond to that? The legislative intent is very clear that divestment is the only answer. Our concern is we think it's a tool. We think it is something we should use. We are using it. We have fired managers over it, but we don't think it's the ultimate tool. We think working towards net zero is the tool. Working through engagement is the tool. Working through BlackRock is the tool. We don't think divestment is the only answer. And that's why we think if you did a comprehensive study, we'd be able to get that answer for you. And the last piece I'll say, and it's more about Act 75. I was instrumental in helping write Act 75. And I think this undermines the authority of Act 75 or the intent of Act 75 to some extent. We were vested with investment decisions as well as investment processes for the state pension funds. We think we've done a really good job, both in advocating for change as well as lowering costs, as well as looking towards the future of how we'll be able to meet the return needs between now and 2038. I think when we start chipping away at that authority, I think it undermines the ability of VPIC to do its job. And I think that's a serious concern that VPIC has. With that, I'll open it up to any questions. I know we submitted a lot in there. I think I've thrown a lot out at you. I strongly recommend you bring in Eric Henry, who is our Chief Investment Officer, who runs it on a day-to-day basis. We have 3 staff people here in the state of Vermont that work for us under VPIC. We're over on Baldwin Street. I think we've done a tremendous amount of work since the 2017 divestment study that we did. We've met all of the goals and objectives that were outlined in that, and we're moving forward now in terms of net zero. So I'm happy to answer any questions or to address any concerns. And we've listed certain suggestions that list or we would add into the bill, as well as our fiduciary letter, which lists potential liability. I think would be. Thank you for your time, and really appreciate any questions.
So, Chair Wonka, really appreciate the detailed information and the really thoughtful suggestions about how we might be able to improve on the work that the Senate bill has. I think the most obvious pieces around index funds are interesting to me. The other piece that I wanted to ask you about specifically was, if I read the Senate's bill correctly, they have essentially carved out the private equity to protect that from. And so I'm trying to understand the comments you made about the having to do the wind down immediately.
Well, how
does the Senate try to address that?
They have and they haven't. They've listed it as legislation intent. It's a legislative intent to include it as part of the de minimis standard. So if you look at it, if you look at the language, it was still included that we have to manage and maintain it and include it in our plan. So it is included in there. The original version that the Senate had basically strictly excluded it. And our objective really was more to keep it out until we actually know the true impact. We don't really know the true impact of what we have in our portfolio for private equity. Maine did a study about a year ago. They have about 7%. Overall of their portfolio is about 7%. They probably have more because they were doing private equity pre-2016, which had a lot more of it in pre-2016 private equity. I don't anticipate that we'd have that much, but to try to pin down a requirement on a de minimis standard with that as part of the definition, I think is difficult to manage. I think you have to more clearly exclude private equity in the language of the bill. It's a little vague. The original versions weren't as vague, I guess, is probably my answer. Why we would have to unwind potentially positions is because I don't think we would be able to get into the quality or the top tier managers at this point because of the nature of private equity. Private equity is really a blind trust. You're hiring a manager. You're hiring a manager and a manager style. You're not really hiring you can't really put restrictions on that. And so private equity lasts 15 years or more in terms of our hold. We may commit now, they may not draw the capital 3 years from now. They may not make money or give money back 10 years from now, and they may wind down the private equity 15 to 20 years from now, or they may be rolled over into a new entity. We don't have the luxury for a couple of reasons. We don't have the legal power, but we don't have the luxury to basically dictate some top tier managers. Because of our $10 million or $20 million commitment, will you change the terms of your contract? They would rather say no, take it or leave it, or B, they won't offer it to us for a variety of reasons. One reason that our chief investment officer said we probably would be excluded was because they wouldn't want the potential liability. And this gets to that legal liability fiduciary language in terms of the bill. Private equity managers, even though it's not specifically listed, would be very hesitant to get into the middle of a legal statute issue if they could get ever dragged into the investment of these funds. If we were forced to actually liquidate funds, which we would do everything in our power not to, but if we had to liquidate funds, they could be upwards of 20, 30, 40% discounts to value, and that would be completely unacceptable. So you can understand my concern on it. You may not agree that you may think there's protections in there that allow us to have that flexibility. Our belief at VPIC is that the protections aren't strong enough, and it's still peppered through the bill in regards to what you will add it as the definition. You will include it in the de minimis standard after the 2030 date. In addition, the 2030 date, it's a little vague in regards to whether or not the de minimis standard extends past that. And so I think clarity of the language in regards to the de minimis statute as well as private equity, I think just needs to be strengthened. We didn't have the time at the Senate to express our concerns. The language came out that Tuesday. We had our VPIC meeting that Thursday. We had serious concerns. They passed it out Friday. We really didn't have a chance at the Senate side to really delve into some of this qualifying language that I put into the memo that I have here. And so hopefully that answers it. I may be more confusing.
No, I mean, the memo is clear. I read the memo and I understand the concerns, and I'm weighing what you're bringing up really seriously and whether I personally want to support digging in and working on the language or waiting to, or just doing the study. I mean, I think there's a bunch of different paths we could take. I'll tell the committee right now and you that I support the value of trying to get our public money out, but I also was part of investing the independence into VPIC to manage this pension fund money, and I believe in what we did.
You also have to understand how the transition is going to play out. So think forward the next 5-10 years. What companies are going to be able to afford infrastructure changes that are going to make that change happen in a reality? And unfortunately, it may be some of these companies that you don't want to talk about today, but may come up with some technology because they have the billions of dollars that are needed. And because we're supporting them in these initiatives for change through our climate action, we can support the companies that are doing that. We can get out of the companies that don't. We can add, this work with BlackRock to create the low carbon index fund, I think is a tremendous first step. We haven't really gotten other states to sign on to it. It hasn't performed as well as our other index fund, but it has been a step into that direction of how do we get the big players that have the trillions of dollars of assets to work with these bigger companies. There is some slides in there in regards to some of her advocacy work. When we started in 2016, I think about 7% of these companies in the Climate Action 100 had commitments to net zero initiatives by 2030. I think there's about 91% of the companies now are up to net zero pledges in the companies that they invest in. And so that's what we're looking at. That's how we will invest our index funds. That's how we will advocate for change. It's not about blanking, setting up a list that we'll never touch. It's about trying to manage those lists through our partnerships with BlackRock, with our investment managers. So we both win. We make money on the investment side as well as do good through our investments and can feel comfortable with the investments that we own. Other states are doing the opposite approach, that they'll get sued if they don't invest in fossil fuel stocks. Texas is a perfect example. They're adding similar language to their bill for the same exact reason, but on the opposite side, they feel they're going to get sued for the other reason. California is thinking they're going to get sued because of or Vermont's position. I think there's some happy medium in there, and VPIC's willing to work with the legislature to do this report. We have some concerns about funding it in future years. Or is this going to be a report that the legislature requires every year as written in the statute? We don't have the staff to do it every year, particularly if we're looking at 10,000 positions and we're trying and companies change and our managers change. And so there's a lot of moving parts that I think this committee really needs to understand on how we manage money and how we can affect change best. And I think Katie Green is the best example of what the state of Vermont offers.
Representative Nugent.
In terms, you're talking about pledges that the companies are making. Can you share a little bit about how they're evaluating the results in their process?
Yeah, Katie would be a great way to. I had it in their slides they put together. If you look at they're measuring it through their net zero global goals, and they're measuring it by. To reach net zero by 2050, emissions need to be reduced annually by about 1.4 gigatons of carbon dioxide. At 2000, so they base it on this, and it's based on the state of Vermont goal, which is 2020 passed the Global Warming Solutions Act by reduce GHG emissions to 26% below 2005 levels by 2025, 40% below 1990 levels by 2030, and 80% levels below 2050 levels. That's the state of Vermont goal, and that's what we use as a benchmark in terms of our climate action. So I don't know if that answers it. More specific, Katie can get into that and she can help you with the specific goals of what they bring to the table.
Yeah, that was going to be my next question, was about the rigor of those net zero pledges and what accountability there really is, and who are third-party independent people. In my business, there's been an enormous conversation about greenwashing and sort of, how do we.
Well, I think how you do it is you become part of a group that represents $68 trillion in assets, and you maintain your membership in that group. If we divest, we're no longer part of that group.
Representative Hooper.
I have in the back of my head that basically news recently that one of the largest Royal Dutch Shell drillers of hole into the crust branched off into significant solar research and production. If this were in place, we would not be in that market, so we would probably end up getting into it later. So the point is that corporations change all the time so they can survive, and coming in on the back end of a great discovery or process change is not the way that we should function.
Well, one thing that Katie has told me is that companies now are linking these global initiatives to compensation. So they're trying to tie in compensation goals for executives to these global goals. And that's really, I think, where this group is really starting to see impact. when it's tied to the compensation of the executives, you tend to see more action in that realm. I know they've had, and they usually pull, like if it makes progress, they'll pull the vote. I know they had some real success with Hess in terms of some of the fracking release of methane in the Bakken region. I know she brought up an example of that in the Seneca Bob's testimony. She can go into the specific details of how we've seen success, how we're seeing more success, and how the power of being part of a group of that nature is really impressive. BlackRock is the industry standard, and you're actually seeing states say you can't work with BlackRock because of that. It's just kind of interesting. But we are working with BlackRock, and we're very supportive of their initiatives in terms of ESG as well as our global decarbonization. We don't call it divestment, we call it more decarbonization for this very reason. We think the goal is more decarbonizing the portfolio, not necessarily just divesting, because companies change, situations change, investment opportunities change that can actually move us a little bit forward faster.
Any other questions for Chair Locke at this point? You've given us an enormous amount to read. I apologize. I've read through your memo, but not everything that you've sent. So I'll be doing some of my homework on this before we move any further. Representative Waters Evans.
Thank you. Can you talk about any possible negative impacts, financial impacts since 2017 when you started, not the divestment, but started making those changes? Did any of those sort of worries at that time about changing the strategy, did any of those come to fruition?
Well, we didn't, the strategy changes we took place in 2016, 2017 were more indexing strategies and adding private equity. The result of the 2017 study for divestment was said that divestment was going to be more expensive, but it advocated for change and it advocated for the initiatives that we've implemented. It really wasn't we didn't.
Right. I guess my question is, because of those changes you implemented, have there been any?
Our low carbon index fund has not performed as well of late in relation to our overall indexing strategy, mainly because energy stocks outperformed last year. So there have been some negative implications, not material, and we're willing to take them to figure out if it's worth it for the portfolio long term to add more money to it. We seeded it with $200 million, and we're evaluating over a longer time frame to see if that's an impact. We did look at the portfolio, what would have happened to the portfolio over the past 3-year average and 5-year average if it were divested in the way that the original bill was worded. And it would have been a loss of about $87 million annually over 3 years and a loss of about $53 million in performance over 5 years. That was looking at our actual index that we have versus what we would have had to go in terms of a divested strategy. So you're not supposed to look at past performance isn't really an indication of future return, but we did look at a 3 and 5 year number. And we wouldn't do it as drastically as that, but that's kind of that causes some of our concern. Our initial read on our portfolio with some of the recommended products that are available right now would have caused a significant drop in our return over the past 3 and 5 year periods. That's speculative, and so I don't want to bank on that. Our goal at VPIC is never to do that, and obviously to maximize the return and minimize the risk. But if we're forced to do certain things or forced to exclude certain asset categories, that's where the numbers can change. We did also do a study in regards to what would it cost if we had to index. And it was an extra $700,000 a year to index. And this was looking at a specific subset of fossil fuel stocks. So it didn't get to that definition yet, but it was about $700,000 more in expenses it would have cost us to use the other index fund. And that was verified through the Maine did a study of the same nature, and they found the same level of increased cost on indexing. It's about, for us, it was worked out to be about $696,000 in extra indexing costs would go forward if we had to do the different indexing strategy. So between now and 2038, by the amortization period, that's $17 million or so, potentially. Now, index fees will come down, and we can evaluate that every year, but that's why I said earlier that I believe there's invariably going to be extra costs, either in increased staff here at VPIC, increased management fees through consultants, or increased indexing fees, all three of which would point up. We don't know the extent of that. And I think that's the purpose of the study. How can we quantify this? And how can we quantify some of our ESG work better for the legislature so you can have better, more informed decisions before you set mandates that list out to 2030 or 2040. That would be our preference.
Representative Chase?
Why would the 3-year loss be greater than the 5-year loss?
The 3-year loss would be greater mainly because fossil fuel stocks did better last year.
Okay.
So if you had to divest of those positions in 2022, you would have done a lot worse. And so that's why the 3-year number is smoothed out a little bit differently.
Okay. So the 5-year would have been a little bit.
Yeah. You had different years where taking out the index exposure to the energy sector wouldn't have been it was maybe did a little bit better in 1 year, but it smoothed it out a little bit more over the 5-year period.
Okay, thank you. There's been a bit of volatility in
Ukraine.
most industries over the last 3 and 5 year periods.
Suddenly olive oil going to zero for a moment.
Let's hope we don't have a pandemic and invade Ukraine again, and then also.
And remember, we have 3 people doing this, and so we're trying to manage the money, hire managers, and also now throw this on top of it. It makes it much more complicated. But we're willing to work with the legislature and how you see fit.
Thank you for giving us very clear things to think about. We're going to be doing more this bill. I will definitely be in touch.
Yep, and I'd be happy to, if anyone has any individual questions, feel free to reach out, and we'll be in touch.
Thank you very much.
Thanks a lot.
So committee, we are going to take a break and be back at 10:45 to take some more testimony from the department on the sheriff's bill. I'm working with stakeholders on some language there that I think is going to need some work. So we'll probably see something either tomorrow or Friday. But the agenda might be switching around a little bit over the next couple of days. I also got a request from the Secretary of State's office to come and respond to some of the things we've heard around ranked choice voting, and they have some ideas that I think may help us focus our work on that and resolve some of the concerns that we've heard. So we'll be hearing from them on Friday. Keep in touch with me if a couple of folks have reached out with agenda thoughts for the next couple of weeks, but the clock is ticking down, so please be in touch with me. If there's something burning you want to make sure that we try to take some testimony on and prepare for next year or get out the door. As we've got a bunch of different vehicles moving, and I know that there are people that are looking at our agenda carefully, and I'm in conversation with many stakeholders in and outside of the room to try to make sure we get done as much good work as we can and maybe leave a few things to chew on when we get back here next year. So please be in touch if there's any strong feelings on any of those fronts. But we'll adjourn and go off.